Danny Lau here with Line Real Estate, empowering individuals and families with financial success through real estate. Today I want to talk about what's the optimal amount of down payment percentage you should put towards your investment properties. Now, I'm going to approach this ideal number from both ends. I'm going to start with little down payment, and I'm going to go into high down payment. And you understand, follow my logic a little bit, you understand what I mean momentarily. So first of all is, you've seen all sorts of advertisements or gurus talking about how they can teach you to buy properties with 0% down or 5% down. Now, that comes with inherent risks because, of course, having less money down, you have a high monthly mortgage. And so for you as an investor trying to make that purchase to have the potential cash flow of the rental cover this high mortgage, there is high risk involved. And then also you may have to cough up money if your calculations are off. Now, beyond the fact that there's huge risk involved, the down payment percentage also is also affected by, the other way around. Your interest rate is affected by your down payment percentage. And so if you have 0% down, 5% down, 10% down, that's not really good enough for the mortgage lender to take the risk on you because you don't have that much skin in the game, so to speak. And so for you to get a better down payment, I keep saying it wrong, for you to have a better interest rate, you should start being in the 25, 30, 40% range so that you can qualify for a better mortgage rate. Now, on the flip side, let's say you have a lot of cash on hand and you're ready to buy a house. Should you buy that investment property all cash? Well, I'm going to make an argument and say that the answer is no. Because a lot of times when you're buying real estate, the benefit to the investor is that you're able to use other people's money, meaning the money from the bank, so that you are not using your own money. And you can, let's say, for example, you have $1 million. Instead of buying a property $1 million up front, you split it into $500,000 for property A and $500,000 for property 2 and get mortgages on both of these properties. Because now, as the investor, you are now controlling $2 million worth of property instead of $1 million worth of property. And then while you're using the bank's money at bottom rates these days, let's say 3% interest rate, and then you can earn 6% on your investment return, that means you are actually pocketing the 3% difference in the yield. And so when it comes to having a large down payment, it's not necessarily optimal for you to not use any borrowing at all. And so using debt healthily in real estate is going to be able to allow the investor to juice up their investment return. So there's actually, on both ends, right? One end is you don't have enough cash and now it's too much risk. On the other hand is you are having too much cash and now you're not getting the proper return that you should be compensated as a real estate investor. And so there's a happy medium somewhere in the middle, and it comes down to your personal appetite. Now, one of my favorite rule of thumb is you want to make sure that whatever, now, of course, assuming that you have enough cash to cover it and you can play with that sliding scale, then my rule of thumb is that your monthly cash flow generated by the rental income itself should cover more than 120% of your debt service. Meaning, if your mortgage is going to be $2,000, 120% of that is $2,400. You want to make sure you have at least $2,400 generated from the rental income. That's the minimum. And so that's because if you have any special maintenance issue or one-time issue that triggers some sort of out-of-pocket expense from you as the landlord, that little extra 20% can create a little buffer room for you so that you can have the flexibility to deal with whatever comes your way. Now, of course, for the more conservative investors out there, you want to have more than 120% of whatever cash flow the rental is being generated. Oh, I'm sorry. You want to make sure your cash flow is at more than 120% of whatever your debt service is. And so now you can pocket the free cash flow generated by the investment that you made, and also take advantage of optimum interest rates so that you're pocketing the difference. Okay, this has been long and rambly, but I hope this makes a lot of sense to the people that likes thinking about numbers. Let me know in the comment section below if there's any other topics you want to chat about next time. And I hope you can share, like, and comment on my comment section below. So hit the subscribe button too. All right, we'll chat next time. See you later. This is dannylau.